Hello, dear algorithms traders. In today's article I will show you why volume generally follows liquidity and not the other way around. This law also contributes to the fact that 90% of retailers lose. Over the last few weeks, we've talked at length about why the stock market is anything but easy. Unfortunately, 16 trillion ways in which the DOM can react to a market order cannot be predicted. In the last few months, new trading coaches have been popping up like mushrooms, telling their disciples that trading is the easiest thing in the world if you only trade what you see. I can only warn you personally about this big mistake and recommend you not to listen to these charlatans. The big players have been in the market for many decades and know exactly what is happening in the market. Incidentally, they are happy about anyone who only acts on what they see at the moment. The only cause of the market movement lies in the market and limit orders, which in turn convey the effect to us using footprint charts, indicators, or the funny volume. Then the intelligence-spared trading coaches come along and add the dollar to the euro in volume trading and tell us that we can see exactly where the market is going. But that's a lot of nonsense, because the fact is that the euro and the dollar never meet in the market. From a mathematical point of view, it makes absolutely no sense to add something that has nothing to do with each other. Intelligence is indeed a rare commodity. Another very important aspect is that limit orders are significantly stronger than market orders. This means that the market orders move the market, but the limit orders ultimately determine where the market goes in the long term. And that's exactly what you should keep in mind the next time you hear a funny story about volume. If you trade according to the principles of volume trading, you will inevitably burn your money. Let's take a look at why this is so. Here we first see a price ladder, and at the top right of the DOM, the limit orders, which are filled by market buy orders. On the bid side are the limit buy orders, which flow into the market sell orders. In principle, these limit orders are even a small glimpse into the future, as they show the willingness of the different market participants to trade. First of all, it is a big advantage to know at which price levels larger offers are available. So, the limit orders show us the future and the market orders only show us the past. But what exactly is the difference between market and limit orders? In principle, market orders cannot be subsequently cancelled once they have been placed. Of course you can close them out again, but then with a possible loss. Limit orders, on the other hand, can be cancelled at any time free of charge provided they have not yet been activated by a market order. Limit orders give us a glimpse into the future, but they can be added or subtracted at any time through spoofing. It should be clear to everyone that the big players are using this to their advantage by distorting the relationship between supply and demand. This inevitably results in legal fraud, which is even tolerated by the stock exchanges. And the advantage of being able to look into the future is diminishing because the limit orders on the ask side can be added or subtracted at any time, and the same is of course also possible on the bid side with limit buy orders. These 4 factors alone lead to 9 different behaviors, which are also influenced by the incoming market orders. Of course, you can also generate important information from spoofing, but this is no guarantee of success. This primarily has to do with the fact that iceberg orders, which hold up the market, are invisible, as are the retailer stops, which mainly move the market. So, there are trillions of possibilities that are responsible for the movement sequences in the DOM. If you try to translate these movement sequences into patterns, you will inevitably fail. We all know that only the market sell orders move the price down and the market buy orders move the price up. However, the unbelievable often happens that suddenly more market sell orders that should push the market down come in, but the market still goes up. How is that possible? Well, by intercepting the high number of market sell orders with an iceberg order on the best bid and at the same time letting the few market buy orders through by reducing the limit sell orders on the best ask. This means that if 105 bears compete against 210 bulls, it should be clear that the price is moving upwards. Perhaps in the future the volume coaches should refrain from adding the market sell orders with the market buy orders in order to get the meaningless number of 110 and instead add the market and limit sell as well as the limit and market buy orders to get a reasonable one to get result. Let's go back to the DOM. On the ask side, 124 lot market buy orders flow into the first stage of limit sell orders. First, the 5 lots are eaten up and 119 lot market buy orders remain. The price jumps up a tick, 43 lots are mined and 76 lots remain. Again the price jumps up a tick, the remaining 76 lots are mined and finally the price comes to a standstill at 1.12600. This means that the 3 lowest levels of limit sell orders can be filled relatively quickly during the course of the market by active market buy orders. In contrast, the last 4 limit levels are relatively safe, as at least 467 lot market buy orders would have to be pushed into the market in order to reach the last limit sell orders. This means that the first limit level is started immediately by the market buy order. The next 2 levels are also easy to reach, the next 3 levels above are moderately difficult to reach and the last 4 levels are the most difficult of the market buy orders to reach. Now imagine that you want to place a fake limit sell order in the market. Where would you set them at the price level 1.12590 or rather higher? Of course, you would move the fake order as far up as possible so that you still have enough time to delete it if the price moves up faster. This is exactly why I developed the 10, 20, 30 and 40% zone for myself. At the first limit level, there is a 10% chance of a fake order. And the further we go up, the greater the probability that a fake order will be placed there. We see the same thing again on the bid page with the limit buy orders. This means that the further we go into the limit orders, the higher the probability that there are fake orders that will be deleted as soon as the price gets close to them. This means that the fewest fake orders are used on the best ask and best bid. Of course, synthetic iceberg orders come in here, which we of course cannot identify. This means that fake potential is lowest in these 3 orders. Now let's take a look at how market buy orders drive the price up. And because it happens so quickly, pay close attention to the best ask and best bid areas. This area is important for us. And why? Well, because the current market buy order clears the current limit sell order, giving us the current market strength at all times. Likewise, the passive, upward limit buy order. The eye of the tornado only moves in this area. In many of my videos we have already talked about how the big player algorithms represent a great power in trading. We see a downward movement here where many short traders enter and set a stop at the same time. Now the big player wants to push the price up to catch the short traders' stops. And it is precisely for this process that the big ones need algorithms. These algorithms are programs that always run in the same way, and although they do not produce any patterns in the chart in the candles or in the volume, they do create clear patterns within the program sequences. In order to push the price upwards, the big player must first fire market buy orders into the market and then delete the limit sell orders he previously placed in the market. The triggered stops then drive the price further up. Then market buy orders are fired into the market again and further limit sell orders are deleted. But unfortunately, it doesn't work the way we see in the picture. If the big players deleted a number of limit sell orders beforehand, all market participants would know that the price was now rising sharply. And for this reason, this usually happens at the current best ask or best bid level. There are exceptions for current news. The big players are pulling out all their limit orders. This order is also not the sequence of the algorithms, because it works exactly the other way around. First the limit orders are withdrawn and then the market orders are fired into the market. And that means, volume generally follows liquidity, and not liquidity follows volume. And this leads to a very interesting finding. Based on the liquidity, we already know where the volume is going. And often a few seconds beforehand. Let's look at a few examples. As the price slowly moves lower, we can already see that the green liquidity on the ask side is getting stronger. This clearly suggests that the price is now going up. We are now accelerating the chart and seeing that increasingly strong market buy orders are entering the market, which are now pushing the price massively upwards. Although liquidity shifts to the bid side from time to time, market buy orders continue to come into the market, catapulting the price upwards. Suddenly the liquidity on the bid side becomes stronger. The market orders are absorbed, and a small pullback occurs, pushing the market lower to get the long traders out and buying the euro at the same time. The liquidity now shifts back to the ask side and the price continues to move upwards. Although the price is slowly moving up, we see that the liquidity on the bid side is significantly stronger. This is an indication that the price will move downwards. Now stronger market sell orders come into the market and the price is pushed down very sharply. Every now and then there is a stronger pullback upwards to get the short traders out. However, the bid side still has the advantage, so we can assume that the price will continue to fall. The price initially runs downwards, the bid liquidity is strong. Suddenly the liquidity shifts to the ask side, which automatically causes the price to move higher. Here too there is a short pullback to the downside to get the long traders out. Then the ask liquidity becomes stronger again and the price continues to rise. The price is trending upwards, but we can already see that bid liquidity is very strong. There is a short movement downwards. The price is then driven up again. Bid liquidity is still very strong, which is now causing the price to fall very sharply. The strong bid liquidity is now shifting to the ask side. A good time to exit the trade. You could see that you can see where the price is going based on the liquidity. Maybe we remember which market orders mainly move the market. Precisely primarily the stops of the retailers. And which limit orders slow down the market? Exactly, they are the synthetic iceberg orders. And both orders are invisible to us retailers, and that is exactly why we cannot react to them. We now know that the price always moves towards liquidity, but only if there are enough stops. A solution to identify the invisible orders is my free Bionic Candle. This means you will be able to identify the retailer's stops with the appropriate experience. Using the Delta Limit chart I developed, I can see exactly what the big players are currently collecting and whether they are entering or exiting. Of course, I need a lot more information for this, which you can see here on my main chart. I also work with 4 other screens that provide me with additional important information. Let's summarize again. Market orders always follow limit orders, and this means we are able to know in advance where the market orders are going. Now everyone can understand why volume trading is completely inefficient and why the future belongs to liquidity traders. Maybe one day you too will be a liquidity trader. I'll keep my fingers crossed for you and look forward to seeing you here again soon. Kind regards, Michael.